I'm 65 years old with a $2 million IRA. Should I be doing Roth conversions? My name is Ryan Janis. I'm a certified financial planner and IRS enrolled agent. And in today's case study, we are going to answer exactly that. Also in this case study, we're going to talk about when does it make sense to do Roth conversions, and based on the data we have in this case study, should we be doing them? And also, what does this actually look like when we model this out and project it so that we can quantify the results of this strategy? So make sure you watch through to the end to see what this actually looks like on the tax return. Now, let's dive into Anna, who's going to be the subject of today's case study. Anna is 65 years old and she has just retired, and she's spending $100,000 a year. We've also determined that Anna is going to wait until age 70 to take Social Security, and she expects to claim about $4,000 per month, which is $48,000 a year, from the program. In addition to this, something that's really important to know about Anna is that her primary goals are to, number one, make sure she doesn't run out of money, and number two, minimize taxes along the way. But she also included that as a secondary goal, she would love if she had the opportunity to leave money to her daughter, again, if she was able to. And so that's something we're going to keep in mind here as we think about the strategies we implement and as it relates to Roth conversions. So let's take a quick look at Anna's net worth. She's done a great job saving. She has $2 million in her traditional IRA. So again, that is $2 million of pre-tax money. In addition to this, she has $200,000 in her Roth IRA for a liquid net worth of $2.2 million. When it comes to Anna's cash flow, we said that Anna's spending $100,000 a year. So up until she claims Social Security, she'll be withdrawing $100,000 from her IRA. And once she does claim Social Security and gets $4,000 a month, we'll need $52,000 from the IRA to get her to that $100,000 a year in spending. Now, here's the time where we're going to answer the question of when does it actually make sense to do Roth conversions? And really, there's two instances where we might want to integrate them into our plan, where one is if our tax rate today is less than our tax rate in the future. This could be as simple as we are in the 12% bracket today, and we know we're going to be in the 24% bracket in the future, and that we can do this simple math and understand that it probably makes sense for us to do a Roth conversion. Otherwise, we might want to think about, well, do we think that tax rates are going to increase from where they are today? Depending on how we feel about that, we again may want to integrate Roth conversions into our plan. But I think a lot of us might find ourselves in almost this equilibrium point where maybe we're withdrawing money at the 24% bracket today, and even 10 years from now, we'll still be withdrawing money at the 24% tax bracket, where we might not have that very clean and easy break in tax brackets where it does make sense to do a Roth conversion. And in that case, we want to think about what other taxes apply to us that might not be as transparent as our regular ordinary tax brackets are. The one tax that we're going to look at today that applies to Anna here is going to be the surcharge on Medicare premiums, called the income-related monthly adjustment amounts. And ultimately, the way this works is that the more income you have that hits the tax return, the more you will pay for Medicare Part B and Part D premiums. You don't get anything more from Medicare for that extra price. It's the same coverage you get with regular Part B and regular Part D. You just have to pay more for it based on your income, and therefore that is actually considered a tax. So let's dive into what these numbers actually look like. If we use the 2025 tax brackets, we see that we're at 10, 12, 22, 24, 32% in terms of our marginal tax brackets here. And just thinking about Anna's taxes here, we know that she will be at the 22 and 24% brackets pretty much no matter what during her retirement, based on just her Social Security and IRA withdrawals alone. But the one thing we have to be concerned about is, based on the balance of her IRA, do we have any concern of crossing into the 32% tax bracket because of required minimum distributions? In addition to this, not only are we looking at her ordinary income tax brackets, we're also looking at the Medicare IRMAA brackets. And so unlike our marginal income tax system, where every next dollar is taxed at the next tax bracket, IRMAA is a cliff. So if we're only $1 over these thresholds, we have to pay higher Medicare premiums for the entire year, right? So this is always done on a year-to-year basis with actually a 2-year look back. So these 2025 premiums are based on what income was in tax year 2023. And so as you'll notice, especially in the individual brackets, right, which is the single tax filing brackets, the premium increases happen quickly at much lower dollar thresholds, which again is going to be really impactful for Anna here. One last piece as it relates to Medicare IRMAA. This number is your modified adjusted gross income. So this is top line that they're using to calculate these premiums. This is not taxable income. Very important distinction to make, because when we're looking at amount of tax we're going to pay based on our marginal income tax brackets, we're thinking about after our deductions. This Medicare IRMAA applies to our income before any deductions. So very, very important that we keep this in mind. And then I want to talk just a moment about required minimum distributions, because this is where we are going to see problems in Anna's tax situation. So Anna, just her regular spending desire of $100,000 a year is not going to cause a tax problem for her. She'll be under the Medicare Part B and Part D IRMAA thresholds. She'll be within the 22% tax bracket. There's no concern there. The problem happens when she hits this required minimum distribution age. And so for Anna, her RMDs are going to begin at age 75. And the way this works is that the government says, you got a tax deduction when you put your money into this account. It has now grown tax deferred for years and years and years. And now, at age 75, we want to collect our slice. So you're forced to withdraw a certain percentage of your account every year so that we can start collecting tax on it. The way that we're going to calculate your required minimum distribution is actually going to be based on what the IRS expects your life expectancy to be. And so they're going to take your December 31st account balance and they're going to divide it by your life expectancy factor. And so if we are 75 years old, they're going to take your December 31st account balance. They're going to then divide it by 24.6, and that is the amount you are required to withdraw from your IRA in the year that you turn 75. And what might not be immediately apparent here is that initial withdrawal rate is close to 4%, and for the first 10 plus years of retirement stays under 7%. And as you can imagine, it's possible that our investment rate of return inside of our IRA exceeds the amount we are required to withdraw on an annual basis, which means that not only is the percentage we're required to take out getting higher and higher and higher every year, but the balance will be getting higher and higher and higher every year. And so while RMDs at 75 may pose a problem, especially here for Anna, it's going to become a much bigger problem at age 80 and age 90, right? These later years in retirement are really where we see the major tax impacts of RMDs. It's not just what happens once they start. And that's going to be really, really important that we keep in mind here as we model out how much Roth conversions we need to do and what this looks like over the course of Anna's retirement. And we're going to jump into that right now. So if we take a look at the tax projection, if we said we're not going to do any tax planning at all, we're just going to take our $100,000 a year in income, and once RMDs start, we're just going to take the RMD, nothing more. This is exactly what the tax return will look like. This is just a quick summary. And if we're just using these clean round numbers at these clean ages, we're going to start at 65 where Anna is today. We're just withdrawing $100,000 a year from her pre-tax IRA just to meet her spending needs, which means that we have taxable income of $83,000. Again, we are under any Medicare IRMAA, right? So we're still in the first IRMAA bracket. We're also in the 22% tax bracket. We're paying $13,000 in tax. Not a bad deal at all for Anna. And if we could stick here, right, that would be a great retirement. But we also then have to think about, well, Social Security is going to kick on at age 70, which means that we're going to get $48,000 a year from Social Security, which means we need to take $52,000 a year out of the IRA to again get us to $100,000. And what you'll notice is that not all of the Social Security benefit is taxable, right? Only about $40,000 of the $48,000 is taxable, which means that she'll actually have less taxable income and just slightly less tax to pay at $11,000. So again, another great situation to be in these early years of retirement. But now let's fast forward to age 75. Age 75 is the first year that Anna has required minimum distributions. And so we were just taking out the amounts we discussed for the last 10 years, we would still have a $106,000 required minimum distribution that comes on top of the taxable Social Security, which means we have $147,000 of modified adjusted gross income. And that immediately puts Anna in a third tier of Medicare IRMAA. What this also does is it brings her to the 24% tax bracket, which isn't a whole big change in terms of a percentage of tax. But what you'll notice is just because of the volume of dollars now hitting the return, her taxes have nearly doubled just because of this one triggering event. That's not where it gets bad though, right? Where it starts to get really difficult for Anna is in these later retirement years, 80, 85, 90. And so at age 80, assuming we're just taking out the required minimum distributions every year, her RMD at age 80 is still going to be about $150,000. And we're just using a really round hypothetical 7% annualized rate of return on the investment accounts, which means her total income here is $191,000. This puts her into the fourth bracket for Medicare IRMAA, right? At this point, she's spending several thousands of dollars more for Medicare premiums than she would have to. This again keeps her though in the 24% tax bracket with $174,000 of total taxable income. At age 85, her RMD is $205,000 and again $40,000 Social Security income, $246,000 of modified adjusted gross income. So she is now in the fifth Medicare IRMAA bracket, again paying several $1,000s a year for Medicare IRMAA. And on top of this, she is now crossed into the 32% ordinary income tax brackets. And this is where a larger problem occurs because we're estimating that Anna put the majority, if not all of the income, right, or all of the money that's in her pre-tax IRA in at the 22 or 24% tax brackets, right? None of the money that's in that account went in and she received more than a 30% deduction. Therefore, we are now doing the opposite of what was intended for this account, where Anna was going to put money in at high income, high tax years and withdraw it in a lower tax, lower percentage year, right? This is the opposite, where money went in at hypothetically 24% is now coming out at 32%. And this is something we want to avoid. And it gets even steeper again as these RMDs get bigger, where she has a $270,000 RMD at age 90. $300,000 in modified adjusted gross income. Again, that's $5,000 a year plus in Medicare premiums that she'll be paying, and taxable income of $292,000, quite a bit now at the 32% bracket, which again, if you look at the total amount of income tax she's paying, and again, this income tax does not include what she's paying for Medicare premiums, that's $71,000 in taxes. So she started her retirement at $10,000 a year in total tax, and at the later end of retirement is paying $70,000 a year in taxes. Right? That is quite a substantial jump. And when you add that up over the course of a lifetime, it is a lot in taxes. And so what do we do now, right? How do we actually use Roth conversions to mitigate the problems that we just saw? Really, we only have to look at 3 years: 65, 70, and 75. And before we start just doing conversions, we want to start thinking about what is the benchmark we want to hit with these conversions, right? What is the threshold? Because we shouldn't just do them arbitrarily. And so with our analysis, we've decided that we are going to do a Roth conversion up through the third Medicare IRMAA bracket, which is going to be about $167,000 of modified adjusted gross income. Again, just using the 2025 numbers to keep things really clean and simple here for the illustration. That means we're withdrawing $100,000 a year for Anna's spending, and the rest is being converted to Roth, and we're going to see $167,000 in IRA total IRA distributions on the tax return. That's where we're getting $167,000 here. That's going to lead our taxable income, after we subtract out the standard deduction, to $150,000. Total tax about $28,000. Now at age 70, Social Security starts, which means that we are collecting $4,000 a month, which is $48,000 a year from Social Security. That means we're withdrawing $52,000 a year for our spending to get us to $100,000, and the rest is being converted from the pre-tax IRA to the Roth IRA. This again keeps at $167,000 of modified adjusted gross income, keeping us at that third Medicare IRMAA tier, and it keeps us at the 24% tax bracket. So as you can see, 65 and 70, we are still consistent even though Social Security has changed, and we're getting a lot of money converted from pre-tax to Roth. Where this becomes impactful is at age 75 when RMDs start. When we have RMDs at age 75, we actually achieve what we call the perfect RMD. And the perfect RMD is a required minimum distribution that is equal to or less than the amount we want to withdraw. And so in this case, we want to have income through that third Medicare IRMAA tier, which is $167,000 in modified adjusted gross income. Therefore, we are still going to have $48,000 of Social Security income. We're still going to take $52,000 out to spend and getting us to $100,000, and the rest will be converted from pre-tax to Roth. This keeps us $167,000 of modified adjusted gross income, keeps our taxable income at $150,000, again at the 24% tax bracket. And if we keep projecting this out, it stays exactly the same now throughout Anna's retirement, which is very impactful because now we're keeping taxes at $28,000, $29,000 a year instead of $70,000 a year. And when you total all of these up, the savings could be quite substantial. So very, very important for Anna to be implementing Roth conversions based on her unique tax situation and what she wants to accomplish. So in short, what are the actual benefits we're seeing from doing Roth conversions for Anna? We are keeping her income level throughout her retirement at the 24% bracket so that she never has to withdraw at the 32% rate, right? Ideally, she's been putting money into this account in the 22 and 24% tax brackets throughout her career. And when she's retiring, we want it to come out at that same bracket. We do not want it to cross over and come out at a higher tax bracket than it went in at. We're also keeping her Medicare IRMAA in check and keeping it level throughout her retirement. And it still probably won't be very fun to pay that Medicare IRMAA for those first 10 years of retirement at that third tier. But it saves Anna quite a bit in premium costs because for the majority of her retirement, especially in those later years, she will be at the fourth and fifth tiers of Medicare premiums, and it's thousands and thousands of dollars of tax savings that she has by keeping it level throughout her retirement. And then ultimately, let's think about her secondary goal of leaving money to her daughter. Now, by doing Roth conversions, we've accomplished one of her primary goals of minimizing taxes, right? We're able to see the benefit of that during her lifetime, but we also have to keep in mind that when her daughter inherits this money in IRAs, she has 10 years to withdraw this money at her ordinary income tax brackets. When it's Roth, she gets to withdraw it tax-free. When it's pre-tax, she has to worry about taxes. And so if we did absolutely no tax planning here, and we just withdrew the amount for spending and for required minimum distributions, what we'd find is that it's very possible Anna passes away with a $3 million IRA, which means that her daughter would have 10 years to realize $3 million at her tax brackets, which leads to almost a certainty at today's tax brackets that she would be paying tax at the 32, 35, and 37% rates, which again defeats the whole purpose of why we were using this account in the first place. The vast majority of this account would actually get converted to Roth throughout Anna's retirement. Her daughter would be able to inherit this account tax-free, let it grow tax-free for 10 years, and make a full withdrawal of that Roth IRA balance, and it would not impact her taxes. So that is across 2 generations, huge tax savings. Can be very, very impactful, especially from an estate planning perspective. And so I hope this video is helpful. And if you want to see how Roth conversions can impact your retirement, take a look at the link in the description below. Thanks for watching.